Hi guys, welcome to Compare Return, and this week's episode is our March 2021 market review. It's been a crazy month in markets for March this year, and there's been a few key things happening that I want to talk to you about in this week's episode. So the first thing is the tech crash. You know, tech has been on an absolute rip for the past 180 days. A lot of people have been saying that it's overpriced and overvalued. Well, this week we've seen a correction in that sector. The second thing I wanted to talk about is Bill Hwang and the Archegos Fund crash. So this actually is a very interesting story. We're probably going to hear a lot more about this. We might even do a whole separate video on it. But effectively what's happened is one of the world's biggest hidden fortunes has been wiped out overnight, which is absolutely crazy. And the third thing we've seen is the Suez Canal incident, obviously with the boat being stuck in the canal and what that means. And for that story, we're actually going to bring you a special guest. So make sure you stay tuned and see that interview later on this episode. So without further ado, let's get started with the tech crash. So what happened, why did it happen, and what's going to happen next? Well, since the NASDAQ highs on February 12th, the index has gone down minus 6.3%, so that's the tech composite index, and the S&P 500, which is sort of large blue cappy type companies, has gone up 1.4%. So now, for the first time in a long time, we've seen a direct inverse correlation between the broader large cap companies in the stock market and the tech companies. So this could be for a few things. Some people, experts in the field, are saying that it's people taking profits out of the tech sector. You know, they've made their 300, 400, 500% returns, so they're starting to take a little bit of that cash off the table. Other people are saying that it's institutional or Wall Street money making a bit of a pivot. So pivoting away from the tech companies and into value companies. So value, which is, you know, sort of your larger companies, your Johnsons and Johnsons, your Coca-Colas, all these have been really hammered since COVID started. So what this means now is they think there might be some good buying in there, some opportunistic buying, as we see things like the virus, so the vaccine come along for recoveries for COVID, and we also see sort of things starting to get back to the new normal, whatever that may mean. This does present mum and pop investors with a unique opportunity to snap up some fantastic buys in the tech sector at a discounted price. So there are definitely opportunities out there. Remember, when people are being fearful, be greedy, and when people are being greedy, be fearful. So some key take-homes here. Here's two ETFs for you, or baskets of stocks. The first one is ARCG, so Arc Web Genomic Revolutions. That's down 23.8% from its all-time high. And we've also got QCLN, which is a green renewable energy fund, which is down 24.4%. These have been fantastic performers over the past few years, so being able to buy them at a bit of a discount might be appealing to some people. Okay, on to Bill Hwang and the Archegos Fund collapse, which is one of the world's biggest fortunes, which was wiped out overnight. What happened, why did it happen, and what's going to happen next? Well, what happened is effectively there was a family-run fund which had about $10 billion on its books, had been making lots of leveraged plays. So what that means is effectively there might be putting $5 in the market, but saying that $5 is leveraged to be worth $50. So if it goes up 1%, it might go up 10%. So if markets go up by 1%, the fund might go up by 10%, so it's leveraged 10 times. But what that also means is if it goes down by 1%, you lose 10%. So what that means is that if you happen to get a 10% drop in the markets, you've actually lost 100% of your money. And that's, in very sort of rough layman's terms, what's going on here. So in the broader market, this actually affected $30 billion of liquidated positions, which is massive. So two of the banks, Nomura and Credit Suisse, were at the center of this. So they were loaning the Archegos Fund and Bill Hwang money. And obviously, since there's no more money to be paid back, these banks are stuck footing the bill. So who is Bill Hwang? He was actually one of the prodigies who studied after fund managing titan Julius Robertson. Anybody who has been in finance for a long time will know him. So he managed to turn $8.8 million into $22 billion. So one of the best fund managers in the world, and his was Tiger, and so the Tiger Funds or Tiger Capital. So effectively, any of the proteges who worked under him, when he finished working, so when he closed down his funds, Julian Robinson that is, he had Tiger Cubs, which were his young fund managers. He chose to set off little funds that he'd put 25 million in. And so Bill Hwang was known as a Tiger Cub in the industry and came off the back of that. So with low interest rates and easy money coming along, Bill went out and borrowed a lot of money and used leverage positions. Since the markets had a correction, this hit him and triggered all the stop losses and basically made the whole fund collapse. Now, why this is an interesting story is this is a family fund. So it's not, like your managed funds you might see in the UK or Australia. It's not like your ETFs you might see in the US. A family fund is basically like a private fund. And what that means, they don't have to do as much reporting to the authorities, which means that the broader market doesn't know what they're up to. So if he's holding a whole heap of companies, a massive position, he might be one person propping up a whole company, and you just never know. So a lot of the guys on Wall Street are crying and screaming out, going, "This isn't right. We need to change the legislations so that if you have over X amount of money, all your positions need to be reported so that everyone else in the market can know what you're doing." So I've got a chart for you here which shows you some of the companies which were affected. We've seen some really big names, guys. So people like Discovery, Viacom, Shopify. So a lot of these guys are, down 60%, which is crazy. GSX as well. Personally, I've had positions in a few of these companies, so just to let everyone know, and taken a loss on these as well. So for the rest of us, it just means effectively, if you're holding some of those companies, bad luck, but if you don't yet, it could be a good buying opportunity. Okay, now on to our final story of the day, which is the Suez Canal situation. And so on today's episode, we have a special guest, which is Steve Eagle. So Steve actually runs a business called How to Buy Australian Made and is an expert in all things shipping, logistics, costing, pricing, and the whole gamut of basically how to take a product to market. So welcome, Steve.
Thanks for having me, Ryan. Good to be here.
Yeah, no, fantastic for coming along, mate. Really appreciate it. So why don't you tell us a little bit about what your particular skill set is?
Yeah, sure. So I guess you could say I'm a product development specialist in terms of my career. 22 years in manufacturing and helping apply those skills now to small business looking to take products.
Okay, fantastic. And obviously the big topic for this week is Suez Canal and the situation with the shipping gluts or blockages, you might want to call it. So do you want to tell us a little bit about that?
Yeah, sure. A really interesting story over the last week. And unless you've been hiding under a rock, you've probably heard about this boat called the Ever Given, which was jammed in the Suez Canal and blocking that waterway. That's a huge problem for global freight, which is already under stress off the back of 2020, with all the flights being taken out of the air. The sea freight was already under pressure. And a problem like this, stopping 12% of global freight moving through the Suez Canal, is just exacerbating that, making it even worse.
Yeah, definitely. We saw last year when COVID first came around, the contango going on with oil, with the futures cost of oil was dipping below, which is what caused that crash. That was basically a lot of VLCCs, which are the very large crude carrier tankers. I don't know whether there was many VLCCs caught up in the Suez Canal situation. Are you familiar with that particular area of the market, or?
Yeah, sure, there were. And actually, a lot of the boats that were caught up were natural gas and petroleum tanking. So that route specifically shipped a lot of Middle Eastern oil into Europe. That's the majority of the trade that happens there in terms of energy. The massive problem for those guys, and we actually measured that over a 3-day period, the cost of contracting an oil had tripled. So a huge impact there, and a lot of the companies producing oil and looking to send that to Europe were left with the hard decision. Do they absorb the cost and wait in line and hope that the problem gets solved, or do they divert and actually go around the Horn of Africa and up to Europe that way? Obviously, massive expense and delay with both options. That expense and delay was measured at one point by the Suez Canal Port Authority at being $400 million an hour in terms of lost trade.
Wow.
So a massive problem.
Yeah, definitely. We saw that last year with the charter rates, the day rates on the VLCC carriers going from, $15,000, $16,000 all the way up to over $100,000. So if the charter rates are now rising again, and you've got a situation where it's either go around the Horn of Africa or wait through the Suez Canal, that's obviously going to be a lose-lose situation for the oil companies. But when you're the one on the receiving end of those charter rates, so that's fantastic. And we've got companies like TK, you've got Frontline, DHT, Euronav, just to name a few companies who have broad and wide shipping entities or verticals within their companies, and certainly probably hitting every single one of those. So a bit of a win for those companies finally.
Yeah, and another thing that we're seeing, I guess, as well, is that this immediate problem of the spike in cost is one thing, but there's also going to be a lingering problem as well with fulfilling a backlog, if you like, of freight that can't happen while these boats are out on the water waiting to do their passage through the Suez Canal. So what's happened there is it's created a vacuum in the freight industry where these boats would normally be in circulation, right? They'd be going from the origin port to the destination port, unloading their cargo, reloading, back, and constantly in this to and fro. While these boats have been stuck waiting for the Suez Canal to be cleared, they obviously can't trade any other goods. So there's a huge amount of freight and in the energy sector as well that's just been, if you like, sucked out of the system until this problem gets solved. What that does is creates backlog in production, right? Because now people producing either have to make the call, do we produce and store on land, or do we contract a really expensive BCCL to help us do it that way, and look at the way to move through that. It's unclear at this point where the penny will land, like who's going to actually carry the bag on this one. But in terms of petroleum and energy products, it's normally the consumer, unfortunately. I think we'll start to see oil prices and energy prices in Europe particularly start to spike over the next month or 2 months.
Yeah, definitely. We've already seen a rise in the oil price. However, and we're looking at also a potential future spike in demand. So as we see a return to normal, so people start to, vaccinations come in from COVID. So talking about COVID now, people are going to be up in the air more often now. So we already had a lot of the refineries at maximum capacity. We had a lot of the boats full of crude already, and we had a lot of the warehouses already stocked up on crude because we had all the demand sucked out of the market. So now that we're seeing demand start to come back into favor and we're seeing a rotation towards recovery industries, this couldn't have come at a more interesting time, Steve.
Yeah, that's really true. And while air travel is resuming, it's a long way off capacity. So it's a long, it's a very big difference between what's happening now in terms of air travel and air cargo as opposed to what was happening in 2019. The Authority for International Travel in Europe, who monitors air traffic, has said that a demand for flights is about 80% lower than what it was pre-COVID. So even though travel is opening, the demand is not there in terms of the commercial levels that we're used to. What this means for a cargo and freight specifically is that all of that air freight would happen in the belly of passenger aircraft is no longer available. And that's about it depends who you listen to, but it's somewhere between a 50 and 70% drop in availability of that sort of. Now, the reason that this is important is because air freight is obviously faster than sea freight. And most small businesses and micro businesses who are now doing very well with their online strategies because of COVID, the demand in online sales and online retail has just shot up. Some people estimate it's been pulled ahead by 5 years. Most of that relies heavily on air cargo to actually fulfill the orders. So if I buy something on Amazon, as an example, and I'm a consumer, I'm expecting that I'll receive it in days, right? That's now an impossibility. And in many cases, these companies are turning to sea freight to fulfill that gap. So there's really no easy way out of this. And the cost is still ramping. We see in our USA businesses, as an example, some of our fashion outlets there reporting back to us that they've had a 600% increase in trade.
Yeah,
so
wow.
it's a really critical issue for online business and small business.
Definitely. As we know, markets look forward. So what we typically see is especially Wall Street costing a lot of this in. So if we look at baskets like the JETS ETF, which is a basket of the American airline carriers, shooting back up 30-40% over the last couple months. If we see the oil price doubling over the last couple quarters as well, we obviously saw that Wall Street was ramping up for this big recovery, and then bam, this situation hits them right in the head. I can see this being an absolute field day for day traders who are looking at the candlestick charts, resistance lines, everything that's going on at the moment. If it's nothing else, is going to cause a ton of volatility. So I guess that leaves us with the question for your clients and for the businesses you run, Steve, what's the solution and how do you fix these kind of things and how do you prevent this from happening?
Sure. So that sector really is in the retail market of physical products, right? That's really where I operate, and a lot of my time being product development. The solution is not an easy one for these businesses, especially if you consider lots of people who were displaced out of the workforce last year, had their conditions changed, had to work from home, had hours reduced, and maybe even lost jobs. A lot of these people turn to online business to try and diversify their income. So how do I shore up my income, become a bit more independent from the workforce and start to look after myself in that way? Amazon was a great solution for a lot of people. Shopify, eBay, these kinds of solutions are where people went to in the majority. The risk for these businesses is that it's very hard to control your margin if you're trading in that way, especially in an environment where things like sea freight and air freight are just climbing out of control, and you really don't have any input. You're subject to the market if you're in that space. A strategy that we're seeing work really well and get very good results is to localize supply chain. So look for a way to find local product in the domestic market where you're selling, or in the domestic market where your business operates, to try and find local producers. And I deal a lot with Australian businesses, so that happens to be Australian made in a lot of the cases I deal with. And we're seeing actually fantastic results there. Some companies even being able to price match Chinese rates in production with Australian manufacturers. Now, that would have been an impossibility even 3 or 5 years ago, but we're now seeing that work very, very well. So I guess the overall message here is look local. If you can find local partners for your manufacturing or for your production, and then you can compete globally with that product while also stabilizing your business model by not being exposed to the things like international freight or currency fluctuation, which I'm sure will come out.
Wow, fantastic. You've actually hit on Ray Dalio's one of his classic lessons, which is the best way to manage a risk is to take that risk off the table completely. So if the shipping is the risk in this ingredient, then taking shipping off the table is always going to fix that risk. Yeah,
that's exactly it. And this is something that is becoming easier and easier for businesses to do. A lot of business before COVID-19 hit had to happen face to face. You had to go and visit the factory. You had to go and visit the trade show, build the relationships that way. A lot of that now is facilitated online through things like Zoom, as we're on right now. And we've been able to contract in our business Fortune 500 companies purely on Zoom meetings in the last 12 months. Now, I hazard to guess that would never have happened. You would never be able to pick up a Fortune 500 company as a client purely on emails and Zoom meetings in an environment prior to. So there are some ways that this is an advantage. And being clever and having a good online strategy with domestic product in your product catalog is really a good way to go.
Absolutely. And we're going to touch on more of that in the rest of this episode when we talk about tech, the current tech crash, and where you can capitalize on some of the growth pockets happening right now. So fantastic, Steve. Thank you very much for your insight. It's always a really rare opportunity to be able to speak with an industry expert such as yourself and get the behind the scenes story on what's going on in the market. So thank you very much.
Thanks a lot, Ryan. Great to see what Compare Returns is doing as well.
Okay, and thanks. And that has been the March 2021 market review. I hope you enjoyed, and thanks for staying to the end. As always, like and subscribe, share this video with your friends, guys. This isn't to be seen as being financial advice. This is simply for educational purposes. So if you are going to be making any investments based on what we've discussed today, please speak to a professional expert or make sure you're doing your own research. Thanks, guys. Have a good day.